Hello, everyone. Carl Weiss at Fairway Independent Mortgage Corporation here with our financial literacy podcast. And today, joining us, of course, is Mr. Clayton Janson, who is a financial planner, a certified financial planner, and accredited investment fiduciary at Focus Financial in the Phoenix, Arizona area. And we've been jumping into our financial literacy section today, and we've covered kind of the beginning side of asset classes. So we've got a person who is earning income in some capacity, who's got some checking and savings account experience in the retail, we'll call it retail banking world, would like to branch out a little bit and have their money maybe work a little bit harder for them, and are considering the investment side of the world that Clay manages so very nicely. And we're talking about the asset classes themselves. So he's already kind of defined sort of the three asset classes. Do you mind popping back into that, Clay, and just recap that briefly?
Yeah, my pleasure. So after you've got that banking, retail banking part, as Carl mentioned, kind of nip, when you move into the investing side, right, where you've got some more risk and some more opportunity there, we're really looking at three asset classes. We're looking at stocks. We call those equities, US or international. You're looking at bonds, which we call fixed income in our industry, but that could be US treasuries, that could be a state or a city bond, that could be a corporate bond. And then we're also talking about alternatives. Now, that's a broader category, but I think a lot of people nowadays are thinking probably cryptocurrencies, regular currencies, gold, precious metals, and maybe even real estate, right? In that alternatives bucket.
Sure. Okay. Um, so, I think maybe if I'm framing this right and trying to help clients kind of on the ladder of this financial literacy, right? If we're used to the banking world and we know what a savings account is at a bank or a credit union, that we understand sort of a conceptual understanding of interest, right? And that is that we make a deposit into an institution and they pay us an interest rate based on that money at some frequency. That could be, look at your statements, but monthly, it could be quarterly, semi-annually, whatever your institution actually pays you, which is probably as close to zero as they can possibly get at this point, right? And so you may have accumulated a savings fund to cover the 6 to 9 months worth of expenses in that account, and you say, okay, I'm ready for my money to work a little harder. Um, can you help us understand that the very next layer above a savings account or a certificate of deposit from a retail institution as to what an income producing investment and a dividend paying investment might be, and what are they?
Yeah, great question. That's exactly a perfect transition. Is once you've got that savings account mapped, what's the next step, right? I think the very next step is you got to talk with folks about bonds, and I think that's again part of the three of those asset categories. But there are some really key elements with bonds that I think get lost in translation, right? Because it does seem like that there is some version of safety there. And I think really the takeaway is that they are typically less, what I'll use the word volatile from a pricing standpoint. Like when you're experiencing your statement every month and you open up your monthly statement, you went out to the mailbox and you grab that statement. If you just put side by side bonds with stocks, those are two of the three asset classes we were talking about. Bonds tend to be smoother in stocks, but there is still some price fluctuation. So let me just kind of go over that real briefly, and I think that might put some clarity on there, and then we'll get into the income part on
Okay.
what people are expecting. So when you buy a bond, and that's what that's the term, but in reality, what you're doing is you're lending your money, right? So a bond is technically a debt instrument. And when I say debt, when I tell people that, Carl, I'm sure it's just like you, right? When you start talking about debt, people start to kind of look at you strange, like, wait a second, it's a debt instrument. The only difference here is that unlike a mortgage where people experience debt or a credit card where people are experiencing debt, it's really the opposite. You are lending your money to
Mhm.
an institution, right? And that institution, call it the US government or call it a corporation that's issuing the bond, you're lending your money to that institution. And let's use the US government for example, for a US Treasury bond. You're lending that money for a certain period of time, and you're in return getting an interest rate paid to you through a yield or an interest rate payment. So a
Right.
common example would be a 10-year treasury bond. So I'm going to take my hard-earned money. I've got my savings account set up, ready to go. Clay, I'm ready to take that next step into the next world of investing, and I want to earn some higher interest. One of those options could be, let's buy a 10-year treasury bond. So just like it sounds, the bond term or the term of time is for 10 years. So you're going to trade that, let's call it $1,000, and you're going to buy that treasury, that 10-year treasury bond. And as a bond holder, I'm really expecting two things, and they're very important. I'm expecting to be paid to lend my money, right? So over that period of time, let's say the bond is paying 4%. I'm expecting to be paid 4% for lending my money on a regular basis, paid timely, right? Never interrupted. So that's important point number one. But the second thing you're expecting is at the end of the 10 years, you're expecting your money back because
Yep.
we've lent it to that entity, in this case, the US government. So it really is a debt. The government owes you the full amount of the money you lent at the end of the term, 10 years, the $1,000. And during the period of the 10 years, they're going to be paying you that 4% interest. So that's the magic of bonds, but there's a twist. The twist with bonds is once you own that bond and you hold that bond, which is again, it's a debt instrument, you can actually sell it. You can sell it in the open market to a different investor. Clay, I really need to get out of this bond holding because I need to buy a house, or I'm helping my kids out buying a car or going to college. But what people forget is in the middle of that time period between the time you bought it and the term of that 10 years, for example, in our example that we're talking about, it is a supply and demand situation. So when you bought it, let's say it was $1,000, right? Somewhere in the middle, it might not be worth that same $1,000 because interest rates in the economy are changing, and it could be worth more or it could be worth less. So you
Correct.
only
That's on
get
a daily basis.
on a daily basis, you only
That's
get
right.
your money back if you hold it all the way through, right? And so
Yep.
that's the part that I think a lot of newer investors, they maybe get caught off guard because they're out there, they're at their mailbox, they're opening their statement. And even though I walk clients through this when we're talking about helping educate new clients, it is kind of a shock when you pull that statement into your house and you open it up and you're expecting that 4% interest. Well, you got the 4% interest payment, but maybe, like Carl's just said, every day the price is going or fluctuating in between the first day you bought it and the 10th year. You might be unpleasantly surprised to find that maybe it went down to $995 instead of $1,000, right? So that price is going
Yeah.
to fluctuate in between. But that's kind of the secret to bonds, is that it's a debt instrument and it's really built on a couple of those variables, right? The interest rate that's being paid, and you getting your money back. And I bring that up because when you lend your money to somebody, it doesn't matter if it's a friend, the US government, or a different entity, you're definitely expecting that money back. So you always want to find out how reliable is that entity, right? What's their credit worthiness? Are they
Absolutely. And I think the other part that's critical on that is that on the daily basis, right? If in the industry we call this held to maturity.
Yep,
So if you bought a 10-year, US Treasury today and you hold it all 10 years, that's held to maturity. And
yep,
you will then get 100% of what you invested back plus the interest rate. But in the meantime, every day there's a fulcrum on the middle
yep,
of the seesaw, and you've got yield on one side of it, interest rate, and you've got price on the other, and that's the open market.
yep,
And so when when the price goes up, yield goes down. And when yield goes up, price goes down. So they're inversely related. And
yep.
so, Clay, tell us what happens if let's say that we bought this U.S. Treasury a 10-year. And just to keep the example simple, since it's there today, let's just use 4.25 because that's what it's at. Um, so you're going to earn 4.25% guaranteed, right, by the U.S. government
Every
for a
year.
10-year
Yep.
period of time. And what happens if to the open market? What happens if rates come down?
Yeah. So we're almost in a situation right now at the date and time of this recording where we might start to see the Federal Reserve lower interest rates. So again, back to that fulcrum, that teeter-totter that Carl just mentioned, right? When we see yields come down, those prices should start to come up. And really, when you think about that from a supply and demand, if you bought this bond today at 4.25, but in 3 months from now, the same 10-year bond is only being issued at 3.25, a whole 1 percentage point less. As
Mhm.
that yield comes down, the bonds that we bought today in this time right now at 4.25 are going to be worth more because you can't go back in time and buy that bond at 4.25. So it's really that teeter totter is a great way to think about it. But the reasoning is that that bond that we own currently is going to be worth a little bit more if we sell it because it's paying 4.25. And trust me, there are lots of investors when that occurs that they're going to wish they would have bought 4.25% bonds 6 months ago, 4 months ago.
Correct.
But yes, that's exactly right. And the opposite is true, is that if the Fed raises interest rates or their interest rates go up from here, the opposite would be true because then if you get a new bond at 5.25 or 6.25, that 4.25 bond does not look as attractive, right? Because those
Correct.
rates are lower.
And that's what I see on a daily basis in the bond world from, on the mortgage side of the world, right? Is when interest rates went, from essentially in the open market from, 3%, let's say to 7%. Well, holy cow, a lot of things internally changed in this bond world
Yep,
for the institutional investors, and certainly price, the price, what it's worth, the actual current value of these bonds deteriorated quite a bit. Now, if these things were held to maturity,
right.
that would not have been such an impactor, right? It's only if you need to sell after day one and before the last day.
That's right.
But I think it's worth noting at a time like this because, uh, I think the world is sort of poised for the possibility of our Federal Reserve to lower rates. And that if that did happen and we did own a 10-year, let's say US Treasury, um, and the price then, would go up and be worth more money, it would act a whole lot more um, like an equity in the fact that you would never have looked for that kind of appreciation, let's say, before.
This is a moment in time, and I've counseled my clients this over the last 6, 7, 8, 9 months. If and when the Fed gets to that decision, this could be something we haven't seen in more than 20 years, right? So it's
Yeah.
one of those opportunities. Yeah. There is some pretty strong data out there that historical that for every 1% decrease in the interest rates, right, from today right forward, that a 10-year treasury bond is going to make an extra 12 to 12.5%, right? Total price return.
Wow.
That's pretty powerful, right? So
Yes, it
that's
is.
the 4% plus the price appreciation, right? So it could, I love how you said it could feel or perform like you would expect maybe a stock to perform. But again, interest rates have to be high already and they have to
Correct.
be ready to move downward. So that we have not seen in this significant of a fashion. Interest rates have not been this high. I mean, we're here in 2024. We haven't seen interest rates as high in 23 years. So
Right.
it's kind of one of those long time in the making. And a lot of my clients who are 40 or 50 years old right now and successful in their own right, successful in business, successful in life, they're savers, they're investors. They've been for many years, but they've never seen this because it really hasn't
Yeah.
been an opportunity in decades. And so if you just have been investing for maybe 15 or 20 years, you haven't seen it. If you're 80 and you're a successful investor, you've seen this before, right? But it's been a long time coming.
And I bring up that idea, the fulcrum of the price versus, the yield, um, for a couple of reasons. One is, when we talk about asset classes, as have sort of defined for us, one of the very first principles is risk. The reason that we're looking to invest money to begin with, outside of the retail banking world, is that is the concept of risk, because the return, the amount of money that we're earning from a savings account is so meager that we need to go out what we call the risk curve. We need to have slightly more, we need to accept more risk personally, in exchange for a higher return typically. And we think of these bonds as incredibly safe. I mean, that's just typically compared to equities. Bonds are much more, because they're a debt instrument and not ownership, right? Um, they're typically the debts that are paid off first, right? Are the bondholders. And equities are kind of paid last, if ever,
Yep.
at failure, at bankruptcy. And so, but the reason I bring it up is part of it also depends on what season of the world you're in, right? 2.5 years ago, when the federal funds rate was 3%, or zero, but prime was 3, people invested into bonds thinking it was quite safe. And what they found is that wasn't necessarily the case if they look at the price of what those bonds are worth today. So,
Right.
those 10-year notes, that were issued back there at 1.25, when rates went to 4.25, are not doing so well. Now,
Right.
again, if you hold it to maturity, you will get whatever interest rate you were promised. But if you sell in the meantime, you could suffer a loss on a very, what was considered, safe, investment. And so sometimes the season matters.
Yep.
And that's worth, I think, bringing up, because I kind of look at this investment world a little bit like a ladder. The very bottom rung, right, is physical cash in your hand. It doesn't, we understand that conceptually. And then the next first rung of the ladder up might be a savings account at a bank. And the rung above that might be a certificate of a deposit. You're going to accept a tiny amount of risk with a guarantee from a bank to get your principal back for a slightly better interest rate, but probably not good enough for you to be excited about,
Yep.
right? So as we continue up the ladder, these layers of risk that we have to accept and go further out what we call the risk curve, we have to understand that not everything is created equal at all times.
That's right.
And that's a really good example, I think, of today, and an opportunity, I think, for a lot of folks who might want to reconsider, talking to their investment advisor, financial planner, and looking at their allocations as we talk about the bond world specifically. But okay, I digress a little bit. So can we go back to the maybe some of the differences of the income producing
Yeah.
versus dividend? I
Yeah.
think
Perfect.
that's
Because
a
that actually
fundamental
fits
thing.
perfectly with your ladder concept. I've used that term before myself, right? So we're going up the ladder on risk. We've got the savings account parts. We've got the bond parts. Other ways to create income. You had brought up the concept of dividends earlier. And sometimes these words get intermingled. And so I want to be
Mhm.
cautious here. And I just want to walk through this slowly. When you usually say the word interest, that in our world, we would typically associate with savings, something at a banking retail entity, or you would think of it as a bond paying an interest rate. Um, in that sense, a debt instrument, which we just got done talking about. So it's usually on that safer side or lower parts of the rung of the ladder. Once you get into dividends, not saying that dividends themselves aren't safe, but you have to remember that a dividend is an income stream typically from an equity or stock investment. And once you cross that rung on the ladder, you've gone from bond to stock. You mentioned it briefly earlier, Carl. You've gone to ownership. When you go from debt to ownership, you've now changed the risk. And so when you invest in a company, a Johnson and Johnson, a Procter and Gamble, these are the big companies that are known, historically known for, we're talking decades, 50, 80, 100 years, they've been paying dividends. A dividend is a representation of you, A, have to be an owner in that company, in the stock, and it's the company taking a portion of those profits, right, that they make and returning it to the shareholder. And the part that I want to stress that's the risk part, in all honesty, is that that company, whether they're selling a product or a service, they are at the forces of the market, right? Supply demand of their product, pricing, what's happening in what you mentioned, right? The cycle of the economy. And so, what if that company goes bankrupt, right? You mentioned earlier, Carl, right? Stockholders are paid the last in a line, if at
Yep.
all, in a bankruptcy, right? So you have to imagine yourself saying, hey, not only could the stock price go down and I've invested money to be a shareholder to get that dividend, but I will be last in line if the worst case happens, right, with that company. So we do want to be clear with clients, right, that interest tends to be on the safer side and dividends tend to be on that riskier side or more risky as you go up the ladder if you're looking for income.
Yeah,
And
I
then of
think it's
course,
so important to
yep,
point that out. And people, I hear people use those terms incorrectly almost
a
daily.
lot. Yep,
And they don't understand the relationship of, like some people will kind of make more of the point of the dividend side of the world being, very consistent. And it's like, well, it can be, or it cannot be, right?
yep,
Whereas the interest rate tends to be an interest paid by an institution or a government or an insurance company. They tend to be more on the fixed rate side of the
yep.
world, like it's predictable, right? You know for a certain time frame what that rate is that they're willing to pay you for in exchange for your lump sum of money. And the dividend side of the world is vastly different. It
Yep.
can be similar, but it's vastly different in that, like Clay said, it like, you pick a Procter and Gamble as an example. If they had incredibly high production costs or had to build new uh, manufacturing facilities, they may pay a little less because it's based on the profit of that year, right?
We saw that case in point with many companies during COVID, which was just started 4 years ago, a little over 4 years ago, right? And we saw a lot of companies they had to make some tough choices, right, economically for their companies during COVID, and they stopped paying the dividend. And
Right.
if you're living off that as a requirement for your budget, that could be a pretty big shock, right? And you might have two things happening to you at the same time. You might have no dividend income, and you might have a falling stock price that you've invested in to get that dividend. And so, again, it's just worth noting historically that that can happen more so historically than a 10-year treasury bond that you bought right before COVID. They still made the income payments, the interest payments, right? So you didn't have to like panic about that. And although prices may have gone down a little bit, they might not have gone down as much as the stock part. So you're going to have a little bit of a different experience. You remember what the definition of asset classes was, right? It's investments that are behaving similarly,
Right.
right? And are often regulated by either taxes, right? Or some other regulations similarly. So that's why stocks and bonds are different, and especially dividends and interest, right? They are different, and just being ready for that. I'd mentioned a concept we had talked about earlier in a prior video. I think this is probably a good spot to mention it. Um, Having experience in these things is priceless. And I'm not saying experience from Carl or myself and sharing that with you. Obviously, we'd love doing that. But you yourself, if you haven't had a chance to see what it looks like to be in a bond, it's very easy to experience that in a very small way. You don't have to overcommit to it. So I always counsel clients, if there's an asset class that you've never actually seen live in your statement, take a small portion of your investment dollars and buy a bond. We have clients that used to buy bonds from their payroll deduction, right, many years ago
Mhm.
from their
Yep.
employer, and buy savings bonds, right? And you get comfortable with it when you see it and experience it. And there's a flip side to that, which I actually want to stress even more, is that when the price does change or you see it on your statement, you can actually then connect that logically and emotionally to what we're talking about here, right? Which is, hey, I'm not hearing Clay and Carl say, hey, go take, $20,000 and buy a US Treasury bond, but it might be a couple $100 of a savings bond or $1,000, right? And
Yep.
something that is low risk for you that's not going to take you off course if it behaves differently than you expected, right? So I always think sampling. It's like just taking a little bite and
Yeah.
sampling that before you get committed.
The sampler platter. I love that. Well, and then that kind of brings us, maybe to the next side. So, okay, so hopefully we've given you a great understanding on the difference between interest as to what you would earn in sort of both sides, whether that's on the investment world or the retail banking world, I'll call it, for an interest rate that might be more on the fixed side. Of course, those are also potentially can be adjustable as well. But to keep it a little more uh, foundational,
Yep.
we've got that side of it. We've got the dividend side, which is a dividend that's, essentially uh, a return earned at some period through ownership of a company instead of just a debt instrument of you loaning a company or a government money. So that kind of brings me to the next thing, which we haven't really talked on much, and we're not going to go super deep into this topic because we can get into the weeds really easy. But let's maybe start a discussion on taxation, right?
Yeah.
Um, so it's a tough one, and obviously, a lot of things come into play with with taxes, with investing, and these things. But I think at a high level, maybe without giving us tax advice, can you maybe comment on how they work for the average Joe and Jane, and maybe help us start with like interest earnings on a savings account, bond interest, and then maybe moving towards the dividends, so we can kind of keep this sort of asset class encapsulated a little.
Yeah. And keeping it foundational, I think, yeah, this is a great next step is talking about I mean, we have a joke here at the firm. It's not so much a joke because it occurs to people, but when you do make money from interest or dividends, right, and you see that in your account, you get pretty excited. But when you do make money, you always got to kind of, take a step back because the IRS is also very interested, right, in getting their fair share of those gains, right? So just kind of be ready for that and always be thinking every time I make money, I got to be ready, right, with the IRS. So, interestingly enough, I think this is kind of an interesting twist to the story. You and I were just talking about ladders, and we were talking about risk, and we were talking about going from savings accounts to bonds up to stocks with dividends. And I think most of our listeners that are probably watching this are thinking, okay, it sounds like it's getting hairier, right? As you go up the ladder, you got to kind of brace for stuff. Almost counterintuitively, from a tax perspective, the taxes are going to be typically a little bit higher on the interest side than they are on the dividend side. And so I think that's a good takeaway to say, hey, diversification is important, right? So if you're also thinking, hey, Clay, I've heard that word before. I think of it, I can't have all my eggs in one basket. And that's important when you're thinking about savings and bonds and stocks and having diversification. But it's also important to know on the tax side. So, Carl, your question about taxes in general, interest is typically taxed at what we call in the tax industry, although I'm not a CPA and I can't provide tax advice, but it is called ordinary income taxes. And the best way to describe ordinary income is it's really how you pay taxes on your earnings, right? If you're working for a living and you get a paycheck, most of our clients that are in that situation, they get it. They know, hey, I might be in the federal income tax bracket, call it 22%, all the way up to maybe 37%, right? So somewhere between the 10 and that 37% mark.
Right.
So right now, and you know this, Carl, better than anybody, with interest rates at 5% in some money market funds, I just want clients to be prepared, right? And I tell clients, hey, you might be making more interest in your money market fund or your CDs at your bank than you're used to. Be prepared to share some of that, right, with the IRS come the end of the year. Yeah, because
There's always a willing partner in the deal, right?
that's right. We haven't seen stuff like this in almost 20 years, right? So be ready that when you start seeing those bigger numbers, where that kind of flew under the radar a couple of years ago when interest rates were close to zero in your bank account, you might not have been paying anything. So just be ready for that. And again, just kind of a technical answer, it's going to be that 1099 INT form, interest, right?
Yep.
So that bank is going to send you that form every year, and they're going to say, hey, here's what you made. And then you're going to file that form with the IRS on your tax return. And then you're going to pay very likely somewhere between that 10 and 37% mark.
Okay, great. So that's the interest side. So that would be, your retail banking
Savings.
accounts,
And
savings
yep,
accounts,
yep.
certificates of deposit, uh, things
And then when
along
you go to that
those lines.
next step, yeah, that next step that we just talked about was bonds. So you're going to see almost identically that same approach, right? You're going to see
Mhm.
that 1099 INT form. So you've got that 10-year treasury bond, right? You've got that corporate bond, and it's going to calculate all of that interest. And again, it's going to be in that same zone, right? That 10% to that 37%. So if you were already thinking, man, I'm just feel like I'm really getting beat up as I go up this ladder with risk. On the other side, again, counterintuitively, a little bit, right? The lower on that ladder you go, you're going to possibly be paying a little bit more in taxes. So be ready for that. The one caveat, I'll just throw it out there. We don't have to get too deep on it. Is if you buy municipal bonds, right? Municipal bonds, which are issued by states and cities. And as a matter of fact, if you buy them in the state that you live in, they are federal tax free and state tax free. So that's kind of the one exception that you might run into and you might want to explore a little bit.
Let me jump on that real quick though. Will those earn essentially the same uh rate of interest as say the 10-year bond?
They will not. They will not
Interesting. Why is that?
because of that very fact, right? So the federal government says, hey, we don't want to mess around with the state of Arizona or the city of Phoenix water projects or building a bridge, right? We're going to let the states do that, but we're going to grant them the ability to borrow money and not have taxation. So yeah, they're typically smaller yields. They're typically less interest. But when you think about that, you're paying less in taxes. So we do a little calculation for clients called taxable equivalent yield. That's probably for a different, segment in a
And we'll
video.
get there. Stay
Yeah,
tuned,
we'll get
people.
there. But
We're
um,
gonna get
but
there.
the situation there is they are going to pay a little bit less interest. But lo and behold, and if you have a CPA or a tax advisor, you'll love them, right? Because there won't be a lick of taxes, federal or state, if you buy them in the state that you live in.
Cool. Thank you. All
And
right.
then on the stock side, to kind of round things out with the tax talk, right? Dividends, dividends again, kind of back to that, opposites world. Dividends are taxed at a much lower bracket. We call that the long-term or capital gains bracket, and that is typically 0 to 20. So just again to picture that again, when you're going up the risk ladder, and now you're in the stock world and you're getting paid that dividend. Carl and I just got done talking about you're taking more stock risk. The price could fluctuate. That company could stop paying the dividend, and now you're out the income. But that dividend is often taxed at a much lower rate than your bond interest. So bond interest, again, and savings closer to that 10 to 37, depending where you fall in the income brackets. But the dividend is going to be 0, 15, or 20. So it can be quite a bit less on those dividends. And then, of course, if you buy or sell a stock, right? In a lot of those cases, if you're buying that stock to get the dividend, you're going to pay the dividend tax rate. But if you sell the stock at a gain, it is also long-term or short-term gains. So way different experience there. The dividend is going to come out on the 1099 DIV form.
Yep.
So you'll be looking for that. And if you sell that stock or you need to, move on past it and replace it with a different investment, and if you have a gain in that stock, that's going to be a different tax form, which is going to be the 1099-B, B like boy. But way different tax experience. So we do have clients that prefer that, especially if you're in that higher income bracket.
Sure.
That's a big deal. If you're 37% on the ordinary income, versus maybe 15 or 20% on the dividend income, that might be enough for you to say, hey, Clay, but I have a tax reason I might need to explore because, right, that might be a bigger bill than I'm worth, than I want to chew on. So,
And I find it, really interesting because, when you think about as we go up the ladder and we're assuming more risk as the investor, it's kind of interesting to note that the federal government is sort of taking that into account, right?
yep,
And so sometimes it's just the way you think about things. So the way I look at that is because the government wants to encourage investment instead of just you being a lender buying a bond, the reward for that, taking that leap of faith to invest money in an equity position, buying an equity, is that you get some tax benefits potentially on the side of the dividend and the capital gains, which, it could roughly be 50% less in tax if you're at the highest,
yep,
marginal bracket, let's say, than the capital gains rate, or close to it anyway.
that's
Um,
right.
and that's no small amount of money at the high end, especially when you think what it would have been on the interest side for the ordinary income taxation. And you work just as hard probably on the personal basis to put money into bond A versus equity B.
Yep.
So that assumption of risk, I think it's kind of interesting that the federal government has sort of uh, given the leg up to the owner side of the world, compared to the lending side of the world for a
Yep.
bondholder.
And historically, they have been the same in the past. And then, just like you pointed out, Carl, sometimes again because of the cycle or political environment or a combination, um, many of our clients have only experienced them the last couple decades as separate, right, and different
Right.
taxations. Yeah.
Right.
So, yeah, motivating, like you said perfectly, motivating an outcome, motivating that
Correct.
investment or that long-term investment. Yeah.
Yeah, I love it. And then what about how do mutual funds work?
Mutual funds, yeah, very similarly to what we were just talking about with selling the stock. So mutual funds, just to define that, because we're doing foundational planning, right? A mutual fund is taking a very typically a similar investment, grouping it together in one bucket, right? So you might have large companies, right, in the United States, all in one bucket. So it helps you stay diversified. So really the same approach where you would buy that mutual fund or exchange traded fund. When you go to sell it, as long as it's 1 year or longer, we call that long-term capital gains, right? 1 year or longer. So that's going to be that 0, 10, or excuse me, 0, 15, or 20% taxation.
Okay.
If you sell it shorter term, less than 1 year, it's called short-term gains, right? And then you're back into the 10 to 37 group, right? So again, it's a timing issue with some of these investments. Same things with selling stocks, but mutual funds, exchange traded funds, if it's short term, right, you just have to watch that when did you buy it to when did you sell it, right? That timeline being 1 year or shorter, you're going to have a little bit higher tax experience.
Which is interesting. Again, you can't help but think,
Yeah,
okay, from the IRS perspective, they're like, no, we want to encourage you to keep this thing longer than a year, so we'll cut the taxes down considerably if you're a high income earner.
yep, yep,
There
yeah,
might
yep.
be some
Interesting. Yeah,
forced logic there, right?
yep,
Um, so that's fantastic, and thank you for the for the overview on the taxation and how things are treated. I think it's important to look, of course, we want to look at things holistically, right? We want
that's
to
right.
look at both sides. We want to make money. Of course, we'd like to keep more of what we make,
Yeah,
and the taxation is certainly a part of that. So, um, let's wrap up this piece and then jump back into asset classes and maybe go a little deeper on to help people, as we're foundational, just to get up a little bit higher up off the ground to understand some of the depths of the asset classes and what might make somebody pick one over another, and what's out there in the world and how they sort of work.
perfect.
So thanks everybody for joining us and tune in to our next segment. We will see you again shortly.